Let's discuss the domestic equity markets. In your latest newsletter, you show the percentage of S&P stocks trading above that 200-period moving average level. Recently, the number is beginning to show signs that the market could be entering overbought territory. Do you expect the correction in equities to continue? And if so, how far?
Well, what we had is in January, when the market peaked out on the S&P at the 1,150, we were very overbought. And then we fell to 1,045. Incidentally, the same day, the gold price fell to 1,045 on February 5th. In other words, a little more than 2 weeks ago. Since then, the market has rebounded. I think we may rebound further, but I don't think that we'll make a new high right away. I think after this rebound, we'll need some more time, and then possibly in April, early May, we could see a marginal new high in the market, but not a convincing new high. And during this marginal new high, I would expect a lot of stocks not to make new highs. In other words, that the number of shares making 12 months new highs would diminish and then eventually lead to some weakness in the second half of the year, whereby the S&P could very well close the year lower than on January 1st.
You know, I'd like to move on to the housing bust. The Case-Shiller Index is showing more than a 30% decline in the median home price. And in a recent interview, both Robert Shiller and Dr. Case expressed their expectations of much lower housing prices. Do you expect this 3-year housing decline to continue?
You see, the problem with making any predictions, whether it's about the S&P or gold or oil or home prices, is really what do we know about how much money the U.S. will print? It is conceivable that home prices will not go much lower than here if the U.S. really embarks on further fiscal and monetary stimulus. But it doesn't mean that they will increase in value a lot right away. They may stabilize, and in some areas, actually, they probably bottomed out already. So I would say after a huge bubble, usually the leadership changes, and I think that in the next few years, you will do probably in U.S. equity better than in U.S. homes. But if the question is, for an individual who has, say, $1 million in cash, should I keep my US dollar million in cash or in US government bonds or buy some real estate? Then I would tell him I would rather buy some real estate for the longer term, for the simple reason that I think the US government, notably the Federal Reserve, will make sure that the value of cash will diminish. Because even if they increase one-day interest rates, they will keep them below the rate of cost of living increases. In other words, interest rates, for as far as the eye can see, will remain negative in real terms. And so on cash, you're bound to lose money. Now, can you make money on cash for the next 3 months or 6 months? There will be the investment environment we're in will be very volatile, and it will be very challenging for investors to shift continuously between real assets and cash. You know, do you want to be in cash when markets correct? Like after early December, the gold price corrected by more than 10%, then you would have to be in cash. But since February 5th, when the gold price bottomed out at 1,045, you had to be in gold again. So this is the challenging environment I'm referring to, and this will be very difficult for most people to navigate. But in general, if you look at the next 10 years, you don't want to own U.S. government bonds, you don't want to own the U.S. dollar, and you don't want to own U.S. dollar cash.
You mentioned U.S. Treasury bonds, bills, notes. There's also corporate bonds and the potential for a cataclysmic slide. In your newsletter, you show a remarkable graph of the big rebound in corporate bonds over the past year or so since the 2008 credit crisis. Do you view corporate debt as a potential Achilles heel here as well?
I think that eventually most debts will not be paid, and it will not be paid either through default or through default by inflating, because if you inflate and print money, as some people maintain, like Stiglitz, a Nobel Prize winner in economics, he said the U.S. will never default because they can print money. Well, printing money is some kind of default, because what you do is pay back the interest and the principal in a currency that will have depreciated in value very substantially. So it's an indirect default, and it punishes, obviously, the middle class very badly. So default or money printing will be the order of the day, and the most unattractive, the least attractive asset are government bonds in the U.S., but corporate bonds in that scenario wouldn't do well either. That's why I always come back. I don't particularly like the stock market, but the alternatives are not particularly desirable, except, of course, for very, very hard currencies like gold, silver, platinum, palladium at the present time.
Well, then on that note of precious metals, following this spectacular run we've seen where gold topped out at around $1,225–$1,226 an ounce, we've seen a correction process as the dollar rallied in the past couple of months. As someone who promises to never sell his gold, you must view this as an ideal time to benefit from discounted precious metals prices.
Yes, but as is the case for the stock market, in my opinion, the correction hasn't run its full course. So I think that we corrected 1226 on December 3rd, 2009 to 1,045 on February 5th of this year, and now we rallied again. I mean, I would not rule out that sometimes this year the price of gold could be lower. But as I say to everyone, nobody is perfect at timing the purchases and the risk for investors. And for people who are concerned about the preservation of wealth is not to own any gold at all. So I can only repeat what I've said 1,000 times already, and this is that a responsible citizen should not trust the U.S. Federal Reserve, should not trust the government, but they should buy some gold every month.
Sound advice, an excellent way to dollar cost average into a solid position. Dr. Faber, for folks who'd like to find out more information regarding your Gloom, Boom, Doom report, could you please tell them how to do so?
Well, they have to go to my website, www.gloomboomdoom.com, all in one word, gloomboomdoom.com.
Well, Professor, I want to thank you so much.
Have a nice day and a nice week.